Okay, so we're closing out 2025, and if you've been following the U.S. commercial real estate market, your feeds have been, well, noisy.
Extremely noisy.
So for today's deep dive, our mission is to cut through that noise. We're going to synthesize what's happening and focus on a really powerful thesis that's emerging.
And that thesis is that North Texas, specifically Dallas-Fort Worth, isn't just participating in the national retail recovery. It feels like it's actually leading it.
It's steering the ship, basically. And this isn't just our take. We've got sources, multiple experts labeling DFW the economic dynamo of the country.
It's a strong claim, but the data backs it up. The population and job growth here is just so relentless that analysts are now seriously asking the question, has DFW reached gateway market status?
Meaning it's truly competing with the coastal giants like New York or LA.
Precisely. And the headlines we're seeing right now really underscore that this isn't some temporary boom. This is a fundamental long-term shift.
Right. And speaking of long-term, we have to note the passing of the influential Dallas investor Tom Hicks. He was a figure who literally shaped the market, especially areas like uptown Dallas.
His legacy is a reminder of the long-term vision that built this powerhouse in the first place. But then you looked at what's happening right now.
The current growth drivers.
Exactly. Take Google. They just confirmed a massive expansion of their data center campus down in Midlothian, south of Dallas. They're adding another 500,000 square foot building.
Let's just pause on that for a second.
Yeah.
This is more than just a big lease. This solidifies DFW's role as a critical hub for global digital infrastructure.
It does. And every one of those data centers, every new tech job, it creates this ripple effect. It demands thousands of support jobs, hundreds of thousands of new homes.
Which feeds directly into the retail demand we're here to talk about.
It creates the necessity. And that's all supported by DFW's industrial might. We just saw a huge 468,000 square foot lease renewal and expansion in Fort Worth by Lasco Products.
So the demand for big box industrial and logistics space is just.
It's insatiable. It really is. It connects right back to DFW's natural advantage as the central logistics hub for the entire country.
Okay, so we've established the foundation. We have the history, the tech infrastructure, the logistics engine, and the population boom that follows. The demand is there. So who's funding it?
And that's the perfect transition into the institutional capital story. It's a complete ecosystem. That operational strength is precisely why big institutional money is following the people right into Texas.
And they seem to be looking for stability in what's still a pretty volatile economy.
Very much so. They are targeting the most resilient retail formats you can find, the necessity-based stuff.
And this is where the numbers start to get a little eye-watering. We're talking about global players making massive bets. Blackstone, for example.
Right. They just dropped an incredible $440 million on a portfolio of Texas retail properties that's across Dallas, Houston, and San Antonio.
But what's so fascinating here, it's not just the dollar amount. It's the specific type of asset they're chasing.
That's the whole story. They are aggressively, and I mean aggressively, targeting grocery-anchored centers. The analysis is pretty clear. In this kind of environment, necessity retail anchored by giants like H-E-B and Kroger is the ultimate defensive real estate play.
Break that down for us. Why is grocery anchored so resilient right now? Is it just about being Amazon-proof?
That's a big part of it, but it's more than that. First, yes, e-commerce has a tough time competing with the local grocery one. But second, these centers have incredibly high occupancy. We're talking 95% plus.
So cash flow is steady and predictable.
Exactly. When interest rates are settling and the market is still finding its footing, stability and predictability are king. That $440 million bet from Blackstone is a huge signal of long-term belief in the Sunbelt's demographics.
And it wasn't a one-off deal. We also saw DLC Management and DRA Advisors come in with a $429 million acquisition.
Another massive deal. That one was for 2.1 million square feet of open-air retail, 91% leased. And critically, that portfolio included DFW's own Watauga Pavilion.
So it just reinforces that pattern.
Yeah.
Investors want stable, necessity-based retail, and they want it here.
They're not chasing speculative home runs. They want reliable returns that are driven by reliable population growth. And this appetite, it goes beyond DFW. San Antonio's market is also tightening up. We saw the Park North Shopping Center there, a huge 633,000 square foot property sell for $115 million. It was 96% occupied.
So even the secondary Texas markets are drawing this big institutional capital.
Absolutely. We're even seeing out-of-state investors, like a Baltimore-based firm called MCB Real Estate, come in and target these secondary metros specifically for stable, grocery-anchored deals. It just speaks to the depths of capital that's hunting for yield across the entire state.
Okay, so that's the defensive strategy.
Mm.
Massive capital flows into safe, proven assets. Now let's pivot. Because DFW isn't just trading old centers, it's also building the future of retail. This is the offensive strategy.
And this contrast is what makes the DFW story so compelling right now. Just look north to Frisco. The $800 million Fields West mixed-use development just hit a major construction milestone.
And this isn't just a shopping center.
Not even close. This is a luxury retail and entertainment destination. It's anchored by a PGA golf resort.
It's a place you spend an entire day or even a weekend, not just an hour.
That's the idea. It's a huge bet on high-end, immersive, experiential retail. It signals that developers believe the high net worth people moving here will support this kind of destination, shifting spending from just buying things to buying experiences.
And we're seeing cities make similar bets. Fort Worth just kicked off its convention center expansion.
Right, and city officials are very open about the fact that they see that project as a catalyst. They expect it to spark a wave of new hotel, retail, and entertainment development right in the city's core.
At the same time, we're seeing really interesting innovation from the retailers themselves. You got this trend of retail right-sizing.
A crucial evolution, a perfect example, is Belk, the department store chain. They just opened their brand new concept store in Frisco. It's called Belk Market.
And it's tiny compared to their old stores, right? Only about 35,000 square feet.
It's a radical change. And it's not just about cutting costs. They're aiming for a more curated, edited selection and an easy-to-shop layout. They're trying to restore their style credibility and just maximize every single square foot.
So DFW is the testing ground for this new, more efficient model.
It's a high-stakes test. Move away from the giant, inefficient boxes of the past to something targeted, local, and focused on the customer experience in a smaller footprint.
Then you have the other end of the spectrum, the quick service restaurants or QSRs. They're just incredibly aggressive right now.
They are. Look at Lane's Chicken Fingers. They're planning to open 44 new restaurants in Texas, and they are specifically targeting DFW for the best drive-through pads and end cap spaces.
That's a massive vote of confidence in the region's growth.
It really is. It tells you they believe the population is growing fast enough to support a huge amount of new quick service business, especially around those high-demand drive-thrus.
Right. And to meet all this demand, even the way things are built is having to adapt.
Right down to the construction. Walmart is experimenting with 3D printed elements for their prototype stores. They think it can cut build times and material waste by 10 to 15%.
Which you have to do when you're trying to build at the speed and scale that a market like DFW demands.
You do. When you have this much capital and this much development happening, everyone in the supply chain has to innovate just to keep up.
All right, let's zoom back out to the macro level because this incredible Texas story still needs a supportive national environment to keep going. And it seems like we're finally seeing some of those financial headwinds ease up.
The biggest signal, without a doubt, was the Federal Reserve's year-end rate cut. It was only 25 basis points, but it was their third in a row. For anyone in CRE, that was a huge sigh of relief.
A clear signal that inflation is finally cooling.
Yes, and that liquidity is improving. For our listeners, that translates into two things. First, it makes future debt cheaper and refinancing less painful.
And second?
More importantly, it creates optimism. It's a signal to all the capital that's been sitting on the sidelines to get ready to deploy. The expectation now is a real jumpstart in deals for 2026.
And it seems like the banks are starting to get that message. The sources say they've tiptoed back into CRE lending.
Tiptoed is the right word. It's not a floodgate, but it's movement. And we can actually quantify that movement. We look at large property deals, anything over $10 million. In the third quarter of 2025, they surged 41% year over year, heading $76 billion nationally.
Wow.
That's not just random activity. That is institutional capital that was frozen by rate uncertainty now being unfrozen and put back to work.
And that confidence seems to be trickling down to even the hardest hit sectors, like office.
Cautiously, yes. Nationally, we're seeing some positive signs.
Yeah.
Vacancy has ticked down just a little bit, net absorption turned positive, and sales volume was actually up 28% year over year.
So analysts are starting to say the office sector is back.
They're whispering it, but we have to ground that in the reality here in DFW, which is very bifurcated. It's a tale of two markets.
Really?
Meaning our best-in-class Class A office buildings in places like Uptown and Plano Frisco are seeing record high rents.
But is that a sign of broad market health? Or is it just a sign that there's a severe shortage of new, high-quality buildings, a flight to quality?
It's definitely the latter. Companies that are willing to pay a premium are all fighting for the same small pool of trophy assets. But at the same time, we're seeing older properties, like the offices at Park Lane, which is only 66% leased, being sold specifically for repositioning.
So the market is recovering, but it's uneven. Quality over everything else.
Exactly. And while we have all this optimism, we have to balance it with the risks that are still out there. There's one big headwind still lurking.
And that would be the old commercial mortgage-backed securities, the CMBS debt.
That's the one. The share of those loans that are in special servicing, meaning they're distressed or facing default, just hit a 12-year high.
A 12-year high. What does that signal for the broader market?
It signals systemic distress, mostly in older office and some older retail portfolios. Think about loans that were written back in 2015 to 2018 at super low rates. They're now coming due in a much higher rate world.
And they can't be refinanced.
Not without a huge new injection of cash. So that's going to force sales or restructurings well into 2026, and that could put some downward pressure on values for those older assets. It's the central conflict. New growth on one side, legacy debt risk on the other.
Okay. That paints a really complete picture. So bringing it all together, the synthesis here feels pretty clear. The DFW market is operating on these two very different, very sophisticated tracks at the same time.
Absolutely. On one track, you have DFW attracting massive defensive capital into those resilient grocery-anchored formats that provide safe, reliable returns. But on the other track, it's acting as this laboratory for innovation. It's driving offensive development, like the huge luxury destination at Fields West, and it's testing these new, smaller, more efficient concepts like Belk Market.
It's the perfect environment where both the safest and the boldest strategies are being executed with, equal conviction. It's really a flight to quality and extreme specialization.
That's the takeaway. Look at Target building these highly curated urban stores in Soho, and then look at Belk debuting a smaller design-focused concept in suburban Frisco. The question isn't if retail is changing anymore.
It's how fast can you adapt?
It's how fast can retailers and developers execute these very specific, innovative new formats to capture market share in a place that's moving at the speed of DFW.
Which brings us to our final provocative thought for you to think about. Based on everything we've seen in the next 12 months in this North Texas market, what type of retail real estate will be the biggest winner?
Will it be the massive, destination-driven experiential hub like Fields West, which requires enormous capital and years to build?
Or will it be the hyper-efficient, highly targeted, smaller store model like Belk Market that prioritizes speed and local curation? Right now, the market is betting hundreds of millions of dollars that both can win at the same time.